Good morning from an icy cold London. It's a real honor to be able to speak to you this morning. And I must say, I'm delighted to hear about all the great initiatives happening in Pakistan. It's wonderful to hear about streamlining regulatory processes, and it's good to have an enlightened regulator. It was one of my jobs when I was at the LSE running all the markets. I ran all primary and secondary markets. I had 80% of the business. I looked after stakeholder relationships. And part of that, apart from talking to issuers and traders and investors, was building relationships with global regulators. And I must say, from what I've heard this morning, what you're doing in Pakistan definitely sets you apart as a regulator. So congratulations on that. Let me just share my screen. So today, I really wanted to do two things. Talk about how you can make your IPO a success. There are an awful lot of things which derail an IPO, and you need to be very well aware of these. So I'm going to focus on the things which go wrong, because an IPO should create huge value maximization, but in a huge number of cases, the opposite happens. And then I'll talk about the case study of the AIM market, and that really shows how a small market can actually succeed, and it enables small and mid-cap companies to actually have a real route to become public, to gain all the benefits of being a public market, being on a public market in the same way as large companies. And AIM, I think, was a unique success story. So I'll go into a lot more detail about AIM later. The first bit, key considerations on making your IPO a success. This just shows some of the experience I've had over the years, but within Clear Mountain, within myself and my partners, we've had multiple experience of IPOs across different markets, across different sectors, across different market sizes. I'm not going to, I'll leave you with the slides later, really, as a reference point. And I'm not going to spend a long time talking about the benefits of going public. I think we all understand those. But the sad truth is that on numerous occasions, IPOs lead to value being destroyed. We see a combination of significant cost overruns. I mean, an IPO can be very expensive. It can cost up to 10% of the funds raised, as well as poor equity pricing. So that can add another 10 to 15% to the effective cost. And in many cases, companies come to the market who are simply not prepared to function as successful public companies. So I don't want to sound negative, but that's a very important warning. According to our analysis, in the GCC between 2005 and 2021, 38% of companies weren't properly priced. And we've seen some pretty major disasters like Swivel, and I'll come back to some points on Swivel later. Now, the really very good news is that these outcomes are totally avoidable. And they're avoidable through utilizing two things. The first is having what I would describe as a sophisticated project management resource from the initial concept of the IPO through the preparation, through the execution, and also through functioning as a public company after you've done the IPO. It's not just about doing the IPO. And secondly, it's having a partner who can provide input into the critical strategic decisions that drive true value maximization. Now, those are some of the things we do at Clear Mountain, but I'm sure a lot of your advisors here can help with those things. This slide goes through in detail the things which go wrong. So therefore, those are the things, if you're doing an IPO, you need to focus on, and where you need input in making the right strategic decisions. It doesn't cover absolutely everything. That would take me several hours, indeed days, but I'm trying to talk about the things you really need to think about. So number one, poor preparation and timing. Successful IPOs take a lot of work and preparation. So the earlier you start the process, the better. And you also need proper advice and take an opportunity. You need to take an opportunistic approach to market timing, and never ever contemplate coming to the market unless you're really in a position to operate as a proper public company. I'll come back to that point later. Cost management, as I already talked about some of the costs, is very important. And you obviously need to properly select and properly manage numerous advisors so they work in a coordinated way in your interests, or costs can really explode. Now, advisors, I'm not trying to denigrate advisors. They do a great job, but they can often take advantage of naive companies. And having been an investment banker for many years, I know exactly how that process works. Being prepared and understanding the due diligence process required to go public and having strong internal organization can save you small fortunes. So you really need to focus on cost management and manage those costs properly. And you need some, in my view, independent help to do that properly. My next point is around board and management. I see numerous examples of public companies with inadequate board skills. Okay, and I think that those are under two different categories. One, you don't have board people who properly understand the key aspects of corporate governance. And to me, one of the most important things around that is how you manage risk. The standards of risk management amongst a lot of current public companies are atrocious. And you need some people with real expertise in risk management and all aspects of corporate governance. But risk management is all around managing the risk around executing your strategies. That's so, so important. And the second part is I see board members who are appointed because they might look good on paper, but their actual understanding of the underlying company is horrendous. We've seen a lot of examples of that in the United States recently. So making sure you have the right board in place and also obviously the right management team at a very early stage is critical. And a lot of people do not pay enough attention to that. My fourth point is around the equity story. We live in a competitive market with many companies trying to raise money. So having a really differentiated equity story based on a clearly articulated strategy is going to set you apart as a company. Now, obviously, that's going to be backed up by the quality, the strength and reputation of your board. Now, without that, there will be no investors or you're going to seriously undervalue your shares. So you have to focus on that at a very, very early stage. An underdeveloped understanding of how to operate as a public entity is a really scary thing. I've seen far too many companies come to market with no idea of what it means to operate as a public company. And that always ends in value destruction. Now, that's a very wide subject, but the key things here include having a culture of operating in the interest of all shareholders, backed by strong corporate governance. I mean, some companies still want to operate as they did as private companies when they become public. The most important thing also is making sure you have the right kind of processes in place to satisfy regulatory and financial reporting requirements. And it's also fundamental to have a strong investor relations function, because having constructive relationships with investors can be the true difference between success and failure as a public company. Now, well-managed investor relations allow companies to use equity as a currency to do deals, as well as raise capital, not just through the IPO, this is a critical point, but on an ongoing basis. Now, this is how you turn companies into global leaders. So you have to be very good at having strategic relationships with investors. And that can be the essence of how you succeed, because I do believe passionately that access to high quality equity capital is what makes companies work and what makes them become true global leaders. I talk a bit, number 7, around suboptimal market choice. I mean, Swivel is a classic case. And most companies rightly list on their local market, where obviously there should be maximum investor interest. But you could consider secondary listings as a part of a new market entry strategy. And there are markets like AIM, which I'll talk about soon, where at times global investors focus their investments in a very specific asset class. So you do need to think about the right market choice. Point 8, suboptimal syndicate selection and management. That might sound very, very technical, but this is really at the end of the IPO process. After you've done all the preparation, the due diligence, it's when you're doing your underwriting and your investor roadshows, assembling the right banks to be underwriters, and making sure they work in a properly aligned way can have a fundamental impact on equity pricing. But that process has to be managed. And it's also very important in having a long-term supportive shareholder base to allocate equity to the right investors. I'll just give you one really good example. When I was running global book running processes, my investment bank wanted to allocate the equity to the clients who gave them the most fees. Now, they weren't the people that were necessarily going to be the long-term holders of the shares that would be most supported to the company. So often the narrow interest of the bank at the end of the process can actually be contradictory to the interest of the company. I had a final part in number 10 about limited visibility and transparency. That actually relates to investor relations. At all times, you have to be fully transparent to the market, to the outside world. That should be a good thing. But if you're not prepared to do that, there's no purpose in being a public company. I won't go through the next slides in detail. They summarize some of the specialist areas where Clear Mountain have a focus and can help support your success, and some of the specialist tools and knowledge we bring in helping you make the right decisions. So please feel free to use those as a reference tool. This slide actually demonstrates the complexity of managing key advisor relationships. We calculate that there are at least 15 relationships involved in managing an ordinary IPO process. So if you don't do that properly, you're going to have a problem. This slide shows all the issues around creating the right board and management and corporate governance structures. This talks about the equity story I discussed earlier. This one is about correct market selection. We have a dynamic market selection tool. This one's all around all the right things you need to consider when it comes to the due diligence process and making that efficient, because that can cause huge cost overruns. I mentioned the importance of investor relations, and we can provide access to the right investors at an early stage, which I think is really important. You need to be engaging with investors early, the right kind of investors, because that is really important in terms of potentially having access to early stage pre-IPO capital, but also finessing your equity story and making sure that you're working in the right way with the market. And we're also actually at this stage overseeing all the marketing materials, which are really important. I'll come back to regulators here, but I know a lot of regulators all over the world, but knowing the local regulator is going to be very important to you. And obviously, you've got an enlightened regulator in Pakistan, so it's less of an issue. But I always stress this to people, because if you don't understand how the regulator works, you end up with an awful lot of problems where people are continually having their documents bounce back, and ultimately maybe the IPO fails. So it's really important to actually have regulatory knowledge. So I just summarize. There's just one more here, which is really the important things you need to think about when it comes to being a public company, all the things you need to have in place. That's really an AIM memoir. I'd summarize by saying that an IPO is clearly not the only way you can maximize value, but we believe it's one of the best ways. But my message to you today is that it only works if it's properly managed from a very early stage, right through preparation, execution, and to being a fully functioning company. You can do it, but it takes proper management and proper preparation. AIM, the alternative investment market, is a very interesting case study, and I know of a lot of interest to your exchange. It shows that markets with very specific attributes and different approaches can actually succeed and make what I would say, well, they do make a very significant contribution to the real economy. I took over management of the AIM market when I started the LSE in early 2003, when it was really just an embryonic market made up of a small number of UK companies. And I'm personally very proud of the impact it had and continues to have. I mean, the numbers speak for themselves. It started with 10 small caps in 1995. I started the internationalization. One of the big things was when I was promoting the LSE, which one of my jobs was the global public face of the LSE, to try and turn the LSE into the most international market. And during my time, the LSE had 20% of all global IPOs. It hasn't done so well since I left, but we were promoting AIM alongside the main market. So we were really pushing international companies to raise capital through AIM. So in 2004, we had 160 companies listed. By 2006, 77 of those companies were international. In 2007, we had turnover in a small cap market of over $100 billion, which is astounding. And so there's one mistake on this slide. It's 2008, where we had $20 billion of capital raised for companies, both in new and further issues. So it wasn't just the primary issue, it was secondary issues. And for 2 years, we raised more money than NASDAQ, which I think was a pretty astounding thing. And in 2008, the market peaked with over 1,600 companies, including 600 international companies operating in 100 countries. So those numbers, I think, are pretty astounding. And in terms of economic impact, and this is really emphasizing what's been said earlier, but the ability of small companies to raise equity capital and not depend on debt finance can represent a real drag on economic growth. And AIM in the UK was instrumental in helping close what we call the equity gap. According to Oxford Analytica, a respected economic consultant, that added between 0.3 and 0.6% to GDP, and that's on an ongoing basis. So that has a huge impact. And also, it made lots of money for advisors, which has positive impacts around government tax takings and being very good for the financial services sector. So I think we generate something like $800 million worth of fees generated in 2008 in London, thanks to the AIM market. Now, you might be asking, why did this work? And this is the fundamental point. The most important thing about AIM to me was intelligent regulation. We created a regulatory model which was based on strong principles. So it enabled both a practical regime for companies, but very high standards of investor protection through things like very high standards of transparency. The key thing at the time was we had an approach in the US, which came from Sarbanes-Oxley, where companies were having to spend huge resource, basically ticking thousands and thousands of boxes. So it's basically impossible for a small company to be listed because the management had to spend all their time on regulation and compliance, not driving the company, which was a disaster for a smaller company. So the regulatory model is critical. The model in the UK was the LSE was the primary market regulator. Unlike the UK list, for main companies, you have to list with the UK listing authority. We outsourced responsibility to nominated advisor or nomads, who made sure the companies were eligible and suitable to come to the market, and they adhered to continuing obligations. So once you're on the market, you had to have a nomad at all times. We had fairly flexible rules with some things like no minimum market cap or free float requirements and limited needs for prior shareholder approvals on transactions. So that was enabling a smaller company to be a public company without ridiculously onerous rules. We were very strict on nomad performance, so I could levy unlimited fines and remove their licenses if they didn't do a good job. We critically attracted a global institutional investor base because they focused their growth investment through AIM, and that was supplementing a very strong retail investor base. So it's really important to have a strong retail investor base. The market was very international, as I said, because we marketed it globally. It was really important. It wasn't just about the raising initial capital. It was about secondary offerings. So that was really important. So if your investor relations strategy works, you've got access to secondary capital. There were also, I'm not sure how it works in Pakistan, but the UK government were very enlightened in giving tax advantages to retail investors. Things like EIS relief and inheritance tax exemptions, they were really, really important. They still are really important, okay, for the market. So you need to combine proper regulation, institutional investors, and also encourage retail investors to make a small cap market work. Now, the really good news is that all the people in the market felt they had a mutual interest in upholding standards, because the most important thing you have to understand about any market anywhere, and sorry, you probably will know this already, is that the essence of a market is a network business. It's all based on reputation. You can destroy your reputation very quickly. So you have to build a reputation, because anyone nowadays can pick up their phone and buy anything anywhere in the world at a click of a button, but they only go to a trusted venue. So upholding the standards of the market, everyone having a mutual interest in that is critical. Just another couple of points. So AIM was seen as a feeder to the main market. So it was enabling companies to transition from being a small cap company to being a fully functioning public company. So it was part of a process. We also had a very wide range of sectors as well as countries, so that gave a diversified risk profile, and also introduced investable indices, which is very, very important for liquidity. So that was the good news. It's not all good news, okay, because at times things don't work properly. So AIM had probably 10 years of problems. That obviously it did coincide with me leaving in 2010 when everything went wrong. But the main reasons were in 2008 with the global financial crisis. A lot of institutional asset managers decided they wouldn't buy anything which was perceived as risky, and that included smaller companies. So the tap was turned off. So that's always a danger for a market. AIM did become a slight victim of its own success because some of the nominated advisors who were later removed chased short-term fees and bought the wrong kind of companies to AIM, which damaged the reputation of the market. We had some European regulation which reduced research coverage, which has been now reversed, one of the benefits of Brexit. But even in spite of all those things, the market showed great resilience. So today, AIM's still got 900 companies, including 250 international ones. It's raised 120 billion since it started. We've had nearly 100 new international companies in the last 5 years. It's very diverse. And the AIM indices have outperformed all major LSE indices. So I do think it's been a huge success. So thank you. Hopefully you can see you can distribute these slides and read them as a kind of reference point. Feel free to contact me or my partner in Clear Mountain of Ace Nackby, who's I think known to many of you here. If you have any questions, we're very, very happy to help or answer any of your questions. We'd be delighted to assist. And as I say, it's a great honour to speak to you this morning. And I'm very excited about all the great work you're doing. Thank you.